Welcome to Your Wealth Matters. I'm Janet Kim Singh, Portfolio Manager at Capstone Asset Management, and today I'm joined by my fellow colleague and Portfolio Manager on a private wealth team, Maria Dawes. Today we're talking about timing. As the saying goes, timing is everything. So how does that affect the way we invest?
Hi, Janet. That's a really good question. And I have actually had a lot of conversations recently with clients who are feeling perhaps a shifting in the wind for a variety of reasons. And we're here to dig into that concept of timing and investments. So let's start with one that is pertinent to the upcoming US election. It can be a great time of uncertainty. And we've heard clients both wanting to put more funds into equity markets and also clients who want to pull out of equity markets for similar reasons having to do with the US election and thoughts around that. So, with that in mind, we had Paul Carter, our senior portfolio manager here at Capstone, put together a little table for you, which you can see here. And all things being equal, what it shows is that for the S&P 500 total return index, so that's the US market, between June 30th and election day, stocks haven't moved much in the last 9 elections. And in the post-election period, from election day to the end of the year, stocks have tended to do very well, whether the winner was a Republican or a Democrat. So that's interesting. In Canada, the results were less statistically significant, as you can see. However, one might look at the results and conclude that a change from a Trudeau-Singh to Poilievre government next year might not be such a bad thing for the Canadian equity markets. So politics is just one scenario that we mentioned because it has come up more recently for us on a few different occasions. But Janet, how about the broader context of market timing in general? What do we know about that?
Yeah, so there was a great article that I recently read by Capital Group, and they basically showed the effects of a $10,000 contribution for 20 years into the S&P 500 index ending December 31, 2023. And the one table showed that if you had contributed 10,000 on the highest day of the market for the calendar year, and the other showed the effects if you had contributed $10,000 on the lowest day of the year. And surprisingly, the results are not so different. The one who would have hypothetically invested on the lowest day of the year returned 12.64% as the average annual return, and the other 10.78%. Now, we're not saying that timing isn't important. However, I think the statistics illustrate that the longer the investment period, the greater the chance of a positive outcome. And then the following came out of the same study, and what they saw over the past 96 years until the end of 2023 was that 94% of 10-year periods have been positive ones when looking again at the S&P 500 index. But if you were to look at a 5-year period, there were 11 negative periods, and over a 3-year period, 15 negative periods. And lastly, if looking only at the 1-year period, there were 26 negative periods. So said another way, when you're evaluating longer time periods, it tends to flush out many of those negative periods, assuming one remained invested. So if you've had a portfolio review with either myself or Maria, you will likely have noticed that while we'll certainly talk to short-term performance, including the year-to-date numbers and the latest one-year performance as well, I think the most important viewpoint for us is the since inception return. Maria, you were speaking to me the other day about something you read on a similar vein. Do you want to talk about that?
Sure. So you're going to have to excuse some of the statistics speak coming up here. I read in my course of studies about an example, which I think to be very fitting given our topic. We can say that, let's say that 94% of market behavior is random. So that's normal. So the equity indices move randomly about 94% of the time. However, at either end lies an extreme, and these tails on either end of the normal distribution are considered to be non-random. Sorry for this. It may be a little bit challenging to follow, but I'll do my best here. But what we're saying is that there are extreme regions of market behavior. A large upward trend will trigger an even larger upward trend. And importantly, when in a downward trend, this tends to trigger an even larger downward spiral as there are more movements out of the market. And this actually results in pretty significant portfolio losses. So there's more extreme behavior on those tails. But again, these tails only happen about 6% on these extreme ends, meaning that most of the times, portfolios will generate an average growth. Now, what does that mean when we're considering a model portfolio? If we assume that we started with, let's say, $1,000 and we invested in the year 1900, so a really long time ago, this amount would grow to just over $500,000, so $537,000 by the end of 2009 using Dow Jones Industrial Average Index returns. As you can see in the table shown, if we look at the extreme scenarios of both worst and best case scenarios such that you either profit by missing extreme losing time periods or you lose because you've missed the extreme gain periods, there are some dramatic results. The gain scenario shows your $100,000 growing to $88 million, which sounds pretty good, right? You think you're a great market timer because you've hit all the best time periods. But I don't think most people live to be 109 years old, so that's a pretty long time horizon. And what are the actual odds of this happening? Believe it or not, it's 1 in 2.6 octillion. So that's 26 zeros in case you're wondering. That's how good you're going to have to be that type of market timer. Now, we're not saying that market timing does nothing, because you can see that if you were able to time things such that you missed both gain or loss extremes, you would achieve a higher return than if you did nothing. However, the strength of a buy and hold strategy is that you remove the risk of your emotions causing you to make bad decisions. Buying and holding over longer periods of time help you take the fear out of missing out, that FOMO feeling, and not timing things correctly on the other side. So you're not really going to rely on your emotions as much, but on a more logical, disciplined approach. Janet, back to you.
Thanks, Maria. I have to say, I really enjoy talking about this kind of thing because it does come up in client conversations fairly often, and I view it to be a very pertinent topic. We want to be opportunistic and take advantage of certain scenarios, of course, where we see fit. And we also want to be prudent where we see potential market disruptions to the downside. So hopefully this does give a bit of insight into how effective market timing actually is when looked at with a longer term lens. Thanks for joining us on another edition of Your Wealth Matters, and bye for now.
Bye.